Today we're tackling mutual fund structure and share classes for the Series 65 exam. A core concept you must know is the calculation of net asset value, or NAV. The exam will expect you to know that NAV per share is calculated by taking the fund's total assets, subtracting its total liabilities, and then dividing by the number of shares outstanding. This calculation is performed once per day at the end of the trading day. An open-end fund, which is the most common type of mutual fund, sells and redeems shares at this NAV. The public offering price, or POP, for a load fund is the NAV plus any applicable sales charge. Now let's break down the different share classes, because the exam loves to test your understanding of their fee structures and suitability. First up are Class A shares. These have a front-end sales load, which is a percentage of your investment that you pay right at the beginning. For example, if you invest $10,000 into a fund with a 5% front-end load, $500 goes to the sales charge, and $9,500 is actually invested. Class A shares are most suitable for long-term investors with a large amount of money to invest. This is because they often offer breakpoint discounts. Breakpoints are volume discounts. The more you invest, the lower the percentage of the sales charge. An investor can qualify for a breakpoint by making a large lump sum investment or by signing a letter of intent, which is a non-binding promise to invest a certain amount over a 13-month period. Next are Class B shares, which are becoming less common but are still testable. These shares have no front-end load, but instead have a back-end load, also known as a Contingent Deferred Sales Charge, or CDSC. This is a fee you pay if you sell your shares within a certain period, typically several years. The CDSC usually declines each year you hold the shares, eventually disappearing altogether. Class B shares are generally suitable for long-term investors with smaller amounts of money who might not qualify for breakpoints. A key feature to remember for the exam is that Class B shares often convert automatically to Class A shares after the CDSC period ends, which reduces their ongoing expenses. Finally, we have Class C shares. These are often called level load shares because they typically have an ongoing 12B1 fee, which is an annual marketing and distribution fee. They might have a small back-end load that disappears after a year or two, but the main cost is the persistent 12B1 fee. Because of these ongoing fees, Class C shares are generally most suitable for investors with a shorter time horizon. A common exam trap is a suitability question, where you have to choose the best share class for a client. Remember this simple phrase: A for upfront, B for back-end, C for continuous. This helps you associate Class A with front-end loads for large, long-term investments, Class B with back-end loads for smaller, long-term investments, and Class C with continuous fees for short-term investments. Another trap is the concept of breakpoint sales, which is the prohibited practice of an agent encouraging a client to invest just below a breakpoint to earn a higher commission. Be sure to recognize this as an unethical practice on the exam. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com.